We hear it all the time. Doing good for the planet is also good for business. But is that always true, especially in the cutthroat world of big real estate? Well, a really fascinating new study on sustainable buildings suggests the answer is way more complicated than you'd think. And it all boils down to one simple thing: location, location, location. So let's get into it. First things first, why should we even care? It really starts with this number: 40%. Our buildings, offices, shops, apartments, they're responsible for a whopping 40% of global carbon emissions. That puts the real estate industry right at the center of the whole climate conversation. And the main characters in our story today are these companies called real estate investment trusts, or REITs. Just think of them as these huge publicly traded companies that own massive portfolios of commercial properties. And because they're so big and transparent with their data, they're the perfect subjects for really figuring out what the relationship is between going green and making green. Okay, so let's start with what most of the research has been telling us for years. This is the established wisdom, what we can basically call the green profit rule. For the longest time, the rule seems super simple. For real estate companies, the better your environmental performance, so the lower your carbon emissions, the better your financial performance. The data has pointed to this again and again. But why, though? What's the actual connection? Well, the logic behind it is actually pretty solid. It's not just some fuzzy correlation. As the researchers point out, greener buildings mean lower energy bills, right? That cuts operating costs. They also tend to attract top-tier tenants who are willing to pay a premium for a sustainable space, and all of that adds up to a higher property value. It's really a classic win-win-win. But, and this is where the story gets really interesting, when the researchers started slicing up the data by location, they found something they totally didn't expect: a paradox hiding in plain sight right in our biggest cities. And here it is, the core finding. For these REITs that operate outside of the major urban hubs, that link between green and profit, it's strong, it's clear. But for the companies headquartered inside the big cities, that financial payoff for going green is, well, it's a lot weaker. Suddenly, the rule starts to break down. So this is the million-dollar question, isn't it? If being sustainable pays off so well in one place, why doesn't it have the same punch in the biggest, most important markets? What is going on in the big city? So, what is going on? Well, the researchers really dug into this urban mystery, and they came up with three key factors that start to explain everything. These are the three culprits: reduced differentiation, elevated costs, and systemic challenges. When you put them all together, they really weaken that powerful link between green practices and profits in a big city. Let's break each one down. Okay, first up, reduced differentiation. The best way to think about this is with, say, oat milk. If you're the only cafe in a small town that has oat milk, that's a huge competitive advantage. But in New York City, every single coffee shop has it. It's just expected. It's the same idea here. In big cities, green building standards are so common and the regulations are so tough that being sustainable doesn't make you special anymore. It's just the cost of entry. Second, elevated costs. And this one's pretty intuitive, right? Everything is just more expensive in a big city: the land, the labor, the permits. So the key point is, even if your fancy new green initiative saves you a bunch of money on your energy bill, those savings can get completely swallowed up by the sky-high costs of just operating in that market. And finally, there are systemic challenges. Think about it. A company can build the most amazing energy-efficient skyscraper in the world, but if that building is plugged into an old, inefficient city power grid, or it's surrounded by traffic and pollution, the overall benefit gets watered down. The city's problems literally become the building's problems. But the study goes even deeper, because it turns out that when we talk about a company's carbon footprint, you have to be really specific. Not all emissions are created equal, especially when you're looking at the bottom line. First, you've got what are called Scope 1 emissions. Think of these as the emissions coming directly from sources the company owns and controls. So we're talking about stuff like the natural gas being burned in a building's boilers, or the fuel used in its fleet of company trucks. Then there's Scope 2. These are the indirect emissions that come from the energy a company buys. The biggest one here by far is electricity. The power isn't made on site, but the company's choice to use that power is what's responsible for the emissions back at the power plant. And here is the key insight. The study found that cutting those Scope 2 emissions, the purchased energy, that's what has a much stronger positive impact on profitability. And this effect was especially powerful for the REITs located outside of major cities, probably because they have more freedom to do things like install their own solar panels and see those direct cost savings. So, after all that, what do we do with this information? I mean, this isn't just some academic puzzle. It has huge, real-world consequences for how we build the sustainable cities of the future. So, what's the bottom line here? Well, for investors, it means don't just read a company's glossy environmental report. You have to check their address. For policymakers, it's a huge heads up that these one-size-fits-all green policies are probably not going to work. And for the real estate companies themselves, the message is loud and clear. Your strategy has to be tailored to your location. But there is a potential game changer on the horizon: artificial intelligence. The researchers think that AI could be the key to cracking this problem. Just imagine these smart systems that monitor emissions in real time, pinpoint exactly where energy is being wasted, and optimize everything across a whole portfolio. That can make green initiatives cost-effective even in the trickiest city environments. Which leaves us with this final, really crucial question. The link between doing good and doing well is obviously a lot more complicated than we thought, especially in our biggest cities. But could new technologies, like AI, finally be the thing that solves the big city paradox and makes going green pay off for everyone everywhere?